Hello everyone, this is Phil Yaeger of Yaeger CPA Review. Effective July 1st of 2013, on the regulation part of the exam, they're going to start asking questions on two new acts. One is the American Taxpayer Relief Act of 2012, and then the Jobs Act, another act which I will discuss. Now, if you are one of our students, there is a handout for each of these sections. Now, if you are not a student, my suggestion is this. Listen, watch this several times. There'll be no limit on our YouTube video how many times you can actually watch this. So watch it as many times as you can. Now, I'm going to be reading from this, and then I'll elaborate if you need to elaborate. It says here, concerning the American Taxpayer Relief Act of 2012, the legislation addressed the expiration of the 2001 and the 2003 Bush Tax Acts, as well as any Obama-era tax benefits, which are enacted as part of his economic stimulus bills. Now, concerning 2012, individual tax extenders. If you are doing a 2012 tax return, one of the deductions to arrive at adjusted gross income was a deduction for $250 for teacher, schoolroom, or classroom expenses. Now, this is still in effect for 2012, and also it will be in effect when you file your 2013 return, because the $250 deduction will expire on December 31st, 2013. Another deduction is an itemized deduction, and that's for premiums for mortgage insurance, all right, which are deductible as qualified residence interest. So when you actually buy a home and you have a mortgage, there's always a problem that should one of the spouses pass away, all right, the surviving spouse will have to continue, obviously, to pay the premiums on the mortgage. Well, not the premiums, but the mortgage payments. So what do? To make sure that you're protected and you will have the money, you take out a life insurance policy called a mortgage insurance policy, which will actually pay off the payments even though one of the people has died or one of the parties to the loan has died. Now, the premiums for these mortgage insurance policies are deductible on Schedule A, and they're classified as qualified residence interest. And this will deduct itself, it will not deduct itself, but it will end on December 31st of 2013. Let me repeat that. Premiums for mortgage insurance are deductible as qualified residence interest, and that will be on the 2012 returns and the 2013 because it expires on 12/31/13. Also, certain states do not have state income taxes that are taken out of your wages. All right, they are Texas. I believe Florida is one of those states. So if you work for someone, they don't take out any state income tax. Well, that's great, but if you itemize, state income taxes that are withheld are an itemized deduction. So the IRS said, let's give these poor people who don't have any state income tax withheld out of their salary, let's give them another type of itemized deduction in lieu of the fact that they have no state income taxes withheld and no state income tax deduction as an itemized deduction. So what they said, the government, is this. You can get a deduction for state and local general sales taxes in lieu of state income taxes. And by the way, this provision will expire on 12/31/13. Now, if you keep every receipt for every item you purchased, it'll show the sales tax. And I don't know too many people that do that, but if you do that, you can add up all of that sales tax and deduct it in lieu of the state income tax if you're in a state that doesn't have state income tax. But we know that people don't keep every receipt. You have to be out of your mind. So what do? Well, there's tables that the government has, and based on your income, they give you an amount of sales tax you can deduct based on an income in a chart that's available to you. Also, the deduction for qualified tuition and related expenses which I believe also is a deduction to arrive at adjusted gross income. I believe it still is, yes. That will expire on 12/31/2013. Now, let's talk about some business tax extenders. Well, the research and experimentation expense credit, that's still allowed, and that will expire on 12/31/13. Also, you can take 15-year straight-line depreciation for qualified leasehold, restaurant, and retail improvements, and that will expire 12/31/13. So, if I rent an office space, if I have to pay the leasehold improvements, very rarely does the landlord pay for the leasehold improvements. But if I, the tenant, have to pay the leasehold improvements, I can amortize them or depreciate them over 15-year straight-line cost recovery. Also, there's been a lot of confusion on what the Section 179 is for 2012 and what will it be for 2013. Well, let's clear that up right now. The maximum Section 179 that you can write off is $500,000, and that will be for years 2010 to 2013. However, you know there's a phase out when your purchases exceed a certain amount. So, for years 2010 through 2013, all right, the maximum annual qualifying property before the phase out is $2 million. So let's go over this. The maximum Section 179, and basically we're concerned about 2012, 2013, that will be $500,000. But it'll start phasing out when your total purchases are $2 million. Now please remember, the Section 179 expense write-off only applies to personal property used in a trade or business, and also that item must be purchased from an unrelated party. Keep that in mind. It has to be purchased from an unrelated party. So those are the amounts for Section 179. Now, this is an item that hopefully your course, I know our course goes over it, all right, and it deals with the built-in gains tax. And what is this? If you are a C Corp and you have property which is appreciated in value, which means the fair market value is greater than the basis. Well, when you become an S Corp, what happens is this, all right, you have to compute a built-in gains tax, all right, which will be a tax to the S Corporation in the year the S Corporation begins. Now, if you cannot calculate the total tax in the first year, you have 5 years, all right, to carry it over and to pay the built-in gains tax. So let me go over this with you. There's a reduction in recognition period of S Corporation built-in gains tax. And by the way, this expires 12/31/13 and requires a corporation to pay a corporate level tax on certain property sales made in a 5-year period, which means 2011, 2012, and 2013, all right, following an S election by a C Corporation. So if they ask you a question, a multiple choice, all right, what's the waiting period, or how many years do you have to carry over in order to actually fully compute the built-in gains tax? And the answer is, for 2011, 12, and 13, it's a 5-year carryover. Please remember that. All right, if you're not familiar with the built-in gains tax, I suggest, all right, you learn it. Now, as I say, in Yaeger, we actually show you how that built-in gains tax works. All right, we show that to you. And by the way, they've asked that on the exam. And I'm not going to go over it here. This is beyond the scope of, showing you the new points about the Tax Act. Now, for 2013 tax returns, the following provisions have been extended from their December 31st, 2012 expiration date. Well, in 2012, all right, you could deduct your full itemized deductions. Also in 2012, you can deduct your full personal exemptions. However, starting in year 2013, for tax years after 2012, which means beginning in 2013, the personal exemptions will be phased out based on your taxable income. All right? So, remember, certain amount of your personal exemption will be phased out if your income exceeds certain limits. Also, certain itemized deductions will also be phased out starting in 2013. All right? And make sure you learn what itemized deductions are not phased out. All right? Some of the itemized deductions are not phased out. They were never phased out. But now, starting in 2013, all right, certain itemized deductions will be phased out again. 2012, you still are doing 2012 tax returns because there's an extension on those until October 15th, 2013. So if they're going to ask you rules for this year, 2013, they're going to ask you 2012 tax laws. So for 2012, there is no phase out of personal exemptions or itemized deductions. But starting in 2013, depending on what your income is, you start losing some of your personal exemptions and some of your itemized deductions. Continuing on page 2, where it says Education Tax Relief, I want to talk about the Coverdell Education Savings Accounts, which they put in parentheses here, ESAs. And these are also, and we saw in the book, they're called Education IRAs. That's what they are. Now, what they did is they increased the annual contribution limit to $2,000. They allow the educational savings account contributions for special needs beneficiaries. You can contribute above the age of 18. If you remember from the book that we're using in the CPA review course, we said that you can only contribute to the education IRA until the beneficiary reaches the age of 18. But here's a change. It says if you have any special needs beneficiaries, you can make contributions above the age of 18. Also, it allows corporations and other entities to contribute to educational savings accounts. But please remember, the contributions are not deductible. And it allows contributions until April 15th of the following year. It also allows a taxpayer to exclude the educational savings account distributions from gross income. And also, you can claim the HOPE and lifetime learning credits as long as they were not used for the same expenses. So if you have a bunch of education expenses and you take out some from the educational savings account to pay those specific expenses, but you still have other education expenses that were not paid out of the educational savings account, you can use for those other expenses, you can take the HOPE credit or the lifetime learning credit for those expenses that were not paid out of the educational savings accounts. Also, one other thing I want to mention is this. In number 2, the student loan interest deduction has no limit, which means that you can deduct the student loan interest deduction as long as you still have a loan for a student. So a lot of you say, well, I thought I could only deduct the student loan interest for 60 months and no more than 60 months. Well, now you can actually deduct the interest for as long as you have the loan. Now, what was the other tax relief, all right, from the American Recovery, let me get the right terminology here, the American Taxpayer Relief Act of 2012. They have so many different acts and names. There must be a person just at the government who comes up with these names. All right, but permanently extends the current estate and gift tax policy, which means that the maximum estate, all right, that will not be subject to estate tax is an estate up to $5 million. But if you have an estate over $5 million, all right, first of all, if your gross estate exceeds $5 million for 2012, you have to file an estate tax return. If your gross estate exceeds for 2012 over $5 million, all right, then you have to file an estate return. Notice I'm not saying taxable estate. If my gross estate exceeds $5 million for 2012 and 2013 and later, all right, then if it exceeds the $5 million, the gross estate, you have to file a Form 706, a final estate tax return. Now, what's going to be the top marginal estate tax rates? Well, for 2012, the maximum top marginal estate tax rate is 35%. But for 2013 and later, it's going up to a maximum marginal rate of 40%. Now, let's talk about some permanent extension of certain tax cuts which were enacted in 2013. If you remember, you got a very low rate on net long-term capital gains and also qualified dividends. Now, when you get a 1099 from a mutual fund, they will show you your qualified dividends and non-qualified. Qualified dividends are those dividends that are subject to a lower rate than non-qualified dividends. Non-qualified dividends are taxed at your highest individual rate. Also, net long-term capital gains, all right, they can get a lower rate than your normal individual rate. Now, how do you determine this? Well, first of all right, if you look at my handout, and it's page 3 for those who have a handout, it says, number 3, there's a 15% tax rate that will apply to qualified dividends and net long-term capital gains as long as your taxable income is up to $400,000, and that's for single taxpayers and head of household. And please note, the 15% rate will apply to married filing joint as long as your taxable income is up to $450,000. Now, if you go over the $400,000 for single head of household or over $450,000 for married filing joint, then the rate will go up to 20%. And concerning certain tax credits, all right, we have an extension of the American Opportunity Tax Credit. And by the way, that credit expires 12/31/17. And what is the American Opportunity Tax Credit? It's just a fancy name for the HOPE credit. All right, the HOPE credit pays for the first 4 years of post-secondary education. Remember that. So the American Opportunity Tax Credit is just a new name for the HOPE credit. Now, let's talk about some Obama-era tax relief. A lot of houses went into foreclosure, and obviously, you would like to be relieved from the debt from your mortgage company. Well, let's assume your mortgage company relieves you of the debt on your principal residence. Well, up until 12/31/13, all right, it says this: discharge of indebtedness on a principal residence will be excluded from gross income. Now remember, this provision expires 12/31/13. Normally, if you discharge from a debt, it's taxable income. But if you discharge from a debt on your principal residence, all right, it will not be taxable income to the taxpayer. This provision will actually expire on 12/31/13. Also, for 2012 and 2013, because this provision expires 12/31/13, you still can take the 50% bonus depreciation. All right. Now, by the way, Section 179, the 50% bonus depreciation, these are only taken on personal property used in a trade or business. They are never taken on real estate. So let me show you the order of depreciation. First of all, if I have a cost of $700,000, all right, what happens is the maximum Section 179 I can take is $500,000. And by the way, this is an expense write-off. I subtract that, and it gives me a basis of $200,000. The next thing I will deduct is the 50% bonus depreciation. So I'll take 50% of this $200,000, which is $100,000. I'll subtract that, leaving me with a remaining basis of $100,000. Now, 179 in the bonus is in the first year. So this remaining basis of $100,000, you can take your maker's depreciation on. And because it is, all right, the first year, you will take an averaging convention method. Averaging convention. Now, what is the averaging convention method for personal property? And the answer is you can have a mid-quarter method, which says if 40% or more of your property is placed in service, all right, during the last quarter of the year, if 40% or more of your purchases are placed in service during the last quarter of the year, then you use the mid-quarter convention method. But if 40% or more is not placed in service during the last quarter, then what happens? You take a half-year depreciation. Now, what do we call the averaging convention method for real estate? That's called the mid-month method. And we're not going to take that because this only applies to personal property. So, all right, once you calculate your maker's depreciation on this figure based on an averaging convention, you also get to take the bonus depreciation and also the Section 179. Now, please note, if they ask you, how much depreciation can you take the first year? My answer would be the bonus depreciation and the regular maker's depreciation. Section 179 expense is really not a depreciation figure. But if they say to you, what's the total expense you can take in the current year? Then include the Section 179 to the bonus and to the averaging convention maker's depreciation. And by the way, all of these items go on Form 4562, which is depreciation. And one other thing before we go to the Jobs Act, all right, let's talk about the annual gift tax exclusion. Well, remember, if you give a gift to someone of a present interest, that means today, all right, and you relinquish all rights to it, it's a gift. And this is what we have here. First of all right, the annual exclusion was indexed for inflation beginning in 1997 and increased from $12,000 in 2008 to $13,000 in 2009. Let me repeat that. All right. In 2008, it was $12,000. Who cares about it? 2008 is gone. All right. 2009, it was $13,000, and it remained that for 2010, 11, and 12. But the annual exclusion will increase to $14,000 for tax year beginning 2013. Now, the next thing I want to talk about is the Jobs Act. The Jobs Act. Well, little information about the Jobs Act. It made significant changes to the federal security laws, including changing the initial public offering process for a new category of issuers called emerging growth companies. And also, it requires the Securities and Exchange Commission to modify the prohibition against general solicitation and general advertising in Rule 506 Reg D. Now, if you remember, Reg D was one of those IDANTs, that's what I call it, the mnemonic, for those situations which you are exempt under the 33 Act from going through a registration statement. All right, and Reg D is where you file Form D, and had 3 rules to it, 504, 505, and 506. And Reg D 506 was an offering over $5 million, all right, and unlimited. And it didn't have to be sold within a 12-month period, all right? It was called a private offering, Rule 506. Now, one of the things it actually did not allow was any solicitation or advertising. But the Jobs Act actually modified that Reg D 506 concerning general solicitation and general advertising. Now, there are several titles to this act. Let's read the titles. Title 1. Title 1 of the Jobs Act created a new category of issuer called an emerging growth company. Now, I would make sure I know what an emerging growth company is. And here's the definition. It's defined as a company with total annual gross revenues of less than $1 billion during its most recently completed fiscal year. Only companies whose first registered sale of common stock securities occurred after December 8th, 2011, may be considered an emerging growth company. Now, under Title I, emerging growth companies are exempted from the audit of their internal controls under Rule 404B of the Sarbanes-Oxley Act of 2002, and also from any potential future rule that the Public Company Accounting Oversight Committee issues with respect to mandatory audit firm rotation and auditor reporting model. So, all right, under these emerging growth companies, all right, they are not subject to the rule dealing with you have a mandatory audit firm rotation and also an auditor reporting model. They're exempt from that. Now, Title II of the Jobs Act requires the Commission to revise Rule 506 of Reg D from registration to allow general solicitation or general advertising for offers and sales made under Rule 506, provide that all security purchasers are accredited investors. The rules that the Commission adopts pursuant to Title II requires that issuers take reasonable steps to verify the purchasers of the securities are accredited investors. Now, what's an accredited investor? He's an investor who actually buys securities on a full-time basis, okay? All right? Also, all right, remember, accredited investors are millionaires, banks, savings and loans, I think it's insurance companies, etc. All right? So, they modified Rule 506 for all publicly held companies and also for emerging growth companies. All right? And what the rule says now is if you are an emerging growth company or a publicly held company, all right, that is now reporting to the SEC under the 34 Act, then please note, all right, when it says here, all right, they allows them to make solicitation and general advertising for offers and sales under Rule 506. So now under Rule 506, they can solicit, all right, but this is only applicable if the investors who are buying their securities are accredited investors only. If they're non-accredited, then no solicitation, no advertising is allowed. Now, Title III of the Jobs Act provides a new exemption, all right, from Section 5 of the Security Acts for offers and sales of securities through what we call crowdfunding. And here's the definition of crowdfunding. You should know it. It's an evolving method to raise capital using the internet. The new exemption provided in Title III will allow businesses to use crowdfunding to sell securities and trying to raise money through the internet to offer and sell securities without going through any registration under the Securities Act of 1933. But it is subject to certain conditions. Amongst its many conditions is this: Title III limits the maximum amount that may be raised by an issuer and the maximum amount that an individual investor may invest in a 12-month period. Now, Title IV of the Jobs Act requires the Commission rulemaking to create a new exemption from the Securities Act registration similar to Regulation A, which will now allow certain small issue offerings of up to $50 million in a 12-month period, and issuers of the securities will only be required to file audited financial statements annually with the Commission. They don't have to offer a offering circular. All right? That was Regulation A. All right? But now, please note, if there's offerings of up to $50 million in a 12-month period, all right, the Jobs Act now says that if you're selling securities, all right, and these are now called small issues, and there are offerings of up to $50 million in a 12-month period, all the issues the company have to file with the SEC are audited financial statements. Now, let's go to Title V. Title V of the Jobs Act requires Commission rulemaking to create a new exemption from the Security Act registration similar, and I just read this, did I not? All right? Skip what I just said, all right? I read Title IV. I'm reading it to you again. Yeah, I'll read it to you again. How's that? You want to hear it again? Title IV, what does it do? All right, it creates an exemption from security registration under the 33 Act, all right, to certain small issues. How much are the small issues? Up to what? 50 million within a what? 12-month period? And all they have to do is just file what? Audited financial statements, okay? Now, Title V and Title VI. Title V and Title VI of the Jobs Act amends Section 12G, don't worry about knowing 12G, of the Exchange Act, which sets forth certain registration requirements for classes of stock. Now, prior to the enactment of the Jobs Act, Section 12(3), all right, and the rules issued thereafter required a company to register its securities with the Commission within 120 days after the last day of its fiscal year, if at the end of the fiscal year the securities were held by 500 or more persons and the company had total assets exceeding $10 million. Now, this was registration under the 34 Act, and this was for reporting companies. This was reporting companies. Now, what does Title V of the Jobs Act amend? It says you can raise the threshold for registration from 500 holders of record to either 2,000 holders of record or 500 holders of record who are not accredited investors. So, if you are a company who is a reporting company, all right, now you can be a reporting company if you have 2,000 holders of record, all right? But the one thing is this amendment, where the number of rules for reporting company goes from 500 shareholders to 2,000, all right? It only applies when you're selling to, I'm sorry, you're not selling, when you're dealing with only non-accredited investors. So please remember that. Let me repeat that. Remember, the 33 Act is an act that talks about registering when you're going through a public offering under the Securities Act, interstate commerce. That's the 33 Act. 34 Act says, all right, certain reporting companies have to register with the SEC either quarterly, annually, and periodically. Now, the definition of a reporting company was under the 34 Act, all right, 500 or more shareholders, all right, and having 10 million plus in assets, all right, and also securities that trade on national stock exchanges are reporting companies. And, all right, please note, if you didn't trade on a national stock exchange, that's when you had to have at least 500 shareholders or 10 million plus in assets also to be a reporting company. And you would have to file forms with the SEC within 120 days after the last day of its fiscal year, all right? But now they've increased a reporting company from 500 to 2,000 holders and 10 million plus in assets, but you only raise this 500 to 2,000 if you're only dealing with non-accredited investors. Now, Title VI applies only to banks and bank holding companies. It amends Section 12G to raise the registration threshold from 500 to 2,000 holders of record, all right? And also, Title V and VI were effective immediately upon the enactment of the Jobs Act. Now, we have Title VII, which says this: effective upon enactment of the Jobs Act, Title VII requires the Commission to provide online information and conduct outreach to inform small and medium-sized businesses, as well as businesses owned by women, veterans, and minorities, of the changes made by the Jobs Act. All right? Now, it says here in conclusion, all right? And by the way, don't worry about this. I'm just reading this to you, all right? It says they still have much to do to be accomplished, all right, concerning the Jobs Act. This is just the beginning, all right? And the Commission, the SEC, and the staff have made progress on and continue to work diligently in implementing the Jobs Act's mandates, all right? So, what's happening is, all right, the SEC and their staff, they're moving forward on the various rulemakings required by the Jobs Act, and they look forward to completing the remaining provisions as soon as it's practical, all right? That's going to be years down the road, let me tell you that, okay? So, the only way you can learn this stuff is, all right, you can listen to this again, all right? So there's some points that are good multiple choice questions. For example, all right, you can raise it from 500 to 2,000, remember that? If you have only what? Non-accredited investors. That was for a reporting company, okay? So that's the type of questions they'll ask you, all right? The number of years to carry over, all right, when you become an S Corp from a C Corp, to calculate the built-in gains tax, all right, you can calculate that only up to 5 years after the asset is transferred from the C Corp to the S Corp to calculate the built-in gains tax. So questions like that are the ones they'll ask you initially. So if you know the basic things I discussed with you, I don't think you'll have any trouble with the new Tax Act as well as the new Jobs Act. Okay? Anyway, please, if you're a student, all right, you'll be able to get a copy. It's a what? A file, PDF file? I'm sorry. Email, all right? Just email our office, all right? Just email our office, all right? And they'll check you're a student, and they'll send you a handout from the handout I was just reading to you, okay? Hey, good luck. Don't be totally intimidated by this, all right? It's just more and more information. And by the way, in 2015, there's going to be an all-new content specification. We don't know what's in it, all right? But you'll be done with it because you still have the remaining 2013 period and also 2014, all right? So don't panic, all right? You can do it as long as you study hard. And please remember, you must know the in-depth knowledge of regulation, all right? I'm not talking about the surface. And also, all right, don't get a false sense of security, or if you're not doing well on multiple choice, that doesn't mean anything. They're not going to repeat the multiple choice. Those are just examples, all right? The multiple choice they'll give you on the exam are different from those. But if you know the rules, you should be able to apply it to any situation, whether it's multiple choice questions they give you or the simulations. So even though some review courses say, just do thousands of multiple choice, if you don't know the concept, I don't care how many multiple choice you make, you're not going to see those again. You're going to see new types of questions. So make sure you understand the rules and the concepts, and you'll get through this exam. Take care and good luck with your studying.